Hey Bowtie Nation, Joseph Hogue here with our new Friday 5 series, a great new series every Friday highlighting some of the best research I've found in stocks over the week. Every week I'll summarize the best analysis and the 5 stocks to watch for some great investing ideas. This next article here is actually 3 stocks in one, doing a deep dive into valuation for shares of 3M, ticker MMM. Shares are down 28% this year, so underperforming the market, though it does pay that 4.7% dividend yield, so it has attracted a lot of investors. The article does start with a warning on dividend aristocrat stocks, seemingly safe companies like GE, like AT&T, with just those decades-long history of dividend increases where the stocks have done nothing but fall mercilessly over the past few years. 3M itself has struggled under a turnaround plan since 2018 and in fact is down almost 50% over the last 5 years. The good news is earnings are up to $10.20 per share this year, so the stock valuation has improved to about 12.5 times on a price to earnings basis. So part of that fall over the last 5 years is it was just ridiculously priced 5 years ago and has come down to a little bit better valuation. Now, over that 5 years, the company has also struggled under litigations, supply chain issues, and a stronger dollar. The payout ratio is now 58%, so it's paying out 58% of its profits, of its net earnings, to satisfy that dividend, which isn't really in the danger zone for industrial companies just yet. Usually, you got to start worrying if it gets over about 60%, but it's still at 58% just does not leave much room for profit behind to grow out of these profit problems. The biggest question right now is the Combat Arms earplug litigation, which could cost the company upwards of $3 billion, according to Morningstar analysis. The article does go on to argue that it won't cost nearly that much, but it is going to be an overhang and probably a burden on the company for at least the next couple of years. My outlook on shares of 3M is with that slow growth and the litigation overhang, they probably don't do much for at least the next 6 months or more. It is a safe dividend, but the dividend growth is going to slow to a crawl, and the company really has no plan for a turnaround here. The valuation, even at that 12.5 times on a price to earnings basis, isn't particularly cheap, and we do have a conglomerate discount here. We've talked about this in the past where these conglomerates like GE, like 3M, they have so many different disparate segments crammed into one company. They usually trade for a valuation of less than the sum of the parts, which is part of the reason why they are planning on spinning off their healthcare business into a new company that is expected to come to spin off in late 2023. That could bring investors back to the shares. We talked about spin-off strategies just a couple of weeks ago. I am investing in shares of GE on that spin-off idea, and you might look at 3M again over the next 6 months on that spin-off strategy, buying those shares before the spin-off so you get shares of both companies when they do spin off, and typically those do outperform the market over the year after the spin-off. The article then goes on to suggest 2 other high-yield stocks. One is Enbridge, ticker ENB. It's a midstream oil and gas company, basically owns those pipelines through which the energy is pumped and collects a strong fee off of energy companies for that. It is paying a 6.6% dividend yield. It's recently announced the completion of the first European offshore wind farm and a potential partnership with Occidental Petroleum, ticker OXY. So that's Warren Buffett's favorite energy company there, OXY, and it's going to be developing carbon sequestration projects. Now, if you do look at the stock price over the past 5 years, it has barely moved, so it's not likely getting much of a boost from those oil prices that are higher this year. This is much more a dividend play in that midstream industry, so you are getting a 6% plus dividend, but the price probably isn't going very far. You are going to get a K1 tax form with this stock, so if you own shares of this stock, it is an MLP, a master limited partnership, so it is taxed differently from regular stocks. You are going to have to work that into your tax plans. A lot of investors out there do not like MLPs because of that. For those of you that don't want it, I do like Kinder Morgan, ticker KMI. It has a 6.1% yield. It is also in that pipeline business. Very strong yield, not much for price growth, but it is a very good yielding dividend stock, and it trades as a stock. You will not get that K1 tax form with this. The article also covers Altria, ticker MO, with its 8% dividend yield and growth just as good as 3M. Now, this is a stable business. Obviously, even in a recession, people are going to be buying their cigarettes, and Altria has a 53-year dividend increase history, but is reporting weak cigarette volume over the last third quarter. The cigarette volume for Altria fell 9%, so the amount of cigarettes it sold fell 9%. That is 1% more than the industry average. So the cigarette industry, tobacco industry, reported an 8% drop in cigarette volume. So that means Altria actually lost market share to some of its competitors, which is never a good sign, right? The increase in prices, because Altria does have some very good brands there, increase in prices helped offset this volume loss a little bit. So the full year revenue is only expected down 1.5%. But the biggest worry for me there is that market share loss if it's falling, if its volume is falling more than competitors. Another problem for me here in Altria is it doesn't have much else in the way of products other than that chewing tobacco and the nicotine pouch brand that's holding up growth. It is also well behind Philip Morris and BTI in its vaping products. So if you're looking out further into the future and you believe that growth outside of cigarettes is going to be in vaping, as I do, then Altria is well behind the curve in some of these other stocks. The PE ratio for Altria is at 18 times on a price to earnings basis, price to sales of 4.1 times, which are both fairly expensive. I think it's too expensive here, even on that high yield. The stability is nice, but if you're looking for that kind of stability and yields in a tobacco company, shares of BTI are trading for about 3 times on a price to sales basis, so quite a bit cheaper, and they still offer that 7.2% yield. We've still got 2 more stocks to watch, including some of the best analysis I've seen on shares of Tesla. And now normally to see these articles, you would need premium access to Seeking Alpha, but join the community here on Let's Talk Money. Tap that subscribe button. I'm going to highlight 5 stocks to watch each and every week. If you do want to check out more of that analysis, though, I've set up an exclusive deal for all you out there in the Bowtie Nation. Now, I started writing for Seeking Alpha back in 2011 and wrote for years before joining a venture capital firm, but I still use the premium access area for ideas and analysis. Use the link I'll leave in the description below to try Seeking Alpha absolutely free for a week, and if you do decide you like it, you're going to get a 60% discount on that premium access subscription. That is $140 off the normal price, the lowest price you're going to find online. In fact, I think it's lower than the price I paid for premium access when I first started. Our first article here about Coinbase Global, ticker COIN. I know a lot of investors watching this. The stock continues to reach all-time lows as investors just worry about the fallout from FTX and that larger crypto winter. Okay, I know Kathy Wood over at ARK has been buying up shares, but the stock is down 87% since the IPO versus Bitcoin down just 71%. And over the last month, shares of Coinbase Global down 23% versus price of Bitcoin up 9% over the last month. So very much underperforming Bitcoin itself and some of these other cryptocurrencies. Now, compared to other platforms, Coinbase does have much better liquidity. Okay, as a publicly traded company, it is more heavily scrutinized by regulators. It does have that war chest of cash to survive for as long as the crypto winter goes. But my point that I've been trying to make since that 2021 IPO, and this is something I've talked about in several videos, is that it is just not competitive against other platforms and not really a good risk-reward trade-off when it comes to whether you invest in a platform like this or in cryptocurrency itself. Okay, first of all, Coinbase is not competitive on fees, is one of the more expensive platforms to trade cryptocurrency, which has brought, of course, has brought traders and investors off of the platform onto others like Binance. You, of course, have that risk of total loss that we saw with BlockFi and so many of these other platforms. Any cryptocurrency you hold on Coinbase is subject to those bankruptcy losses. Albert Lin here argues that Coinbase business model just doesn't work in the current environment. He talks about the retail transactions make up 80% of the revenue, so the company is very dependent on that retail investors and sentiment, which is very low right now. And while traditional exchanges like the Chicago Mercantile Exchange, that ticker CME, and the ICE, they do well with increased trading around volatility, Coinbase just isn't working like that, okay? Coinbase, the shares are much more tied to the value of that commodity itself. So if you look at shares of CME, if you look at shares of ICE, they don't trade in correlation. They don't trade up and down with a lot of the commodity prices, right? They make those exchanges make fee revenue on the trading, and with increased trading, with increased volatility, they tend to do better. Whereas Coinbase isn't functioning much like an exchange, right? Like a traditional exchange. It is rising and falling with the commodity itself. So again, is why I've been arguing that I would rather just own Bitcoin or Ethereum outright. To do so through futures contracts is what I do now, owning a long position in a futures contract on BTC and ETH, as well as just some cryptocurrency in cold storage. So it's off of those exchanges, it's off those platforms. You have no risk of total loss on those. My point is just why take the additional risk of loss on a platform, and why invest in a platform that is likely going to underperform crypto? So I know a lot of you still like shares of Coinbase. I just think it's going to have a very tough time competing, even if cryptocurrency prices rise. It's just going to have a tough time competing against some of these other platforms and making the kind of returns that you could see in cryptocurrency anyway. We still got one more article with some great analysis on shares of Tesla. But first, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching as well as the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. Fifth stock to watch this week, one of the most exciting in the market, shares of Tesla, ticker TSLA, now down 48% in just the last 3 months, down to just 6.8 times on a price to sales basis, well below what it's traded in the past couple of years. The company is expected to report $83.5 billion in revenue this year. That would be up more than 55% from last year. So still very much a growth company. Now these shares traded as high as 25 times on that price to sales basis in 2020. But they did trade as low as 3 times in 2019. So that 6.8 times price to sales ratio right now, not necessarily extremely cheap, but well off of the highs. The average has been around 10 times sales over the last decade, which would mean that current price to sales ratio is about 47% discount. The big news recently for shares of Tesla has been reports out of Bloomberg and Reuters that the company is cutting its production at the Shanghai Gigafactory by as much as 20%. That production from that factory represents 40% of the total company production. So that 20% cut on that 40% would be about an 8% cut to total production. So which would be a material decrease in production for Tesla. Now the article does point out that November was abnormally high on orders, especially from that Shanghai Gigafactory. And the company has pushed through a lot of big end of year incentives. So really pushing customers to lock in their orders before the end of the year. So a lot of that 20% cut might just be bringing the production back to normal rather than any kind of a big slowdown or a big production cut. In fact, the Wall Street Journal points to a YouGov survey that shows the favorability for Tesla. You see here from 2022 all the way to current net favorability for Tesla on that survey of people. It was as high as 6.7% just as recently as May 16th, but has just come crashing down over the last 6-7 months. Now net favorability for Tesla is down to negative 1.4%. Of course, Elon Musk has always been an over-the-top personality, and that's going to rub some people the wrong way, but he's never been overtly political until now. And in today's hyper-partisan environment, that could detract from sales for the company. The Wall Street Journal also points to the net favorability in this survey, net favorability by political affiliation. And you can see here this light blue line for Republicans reporting a net favorability of 32% for Tesla back here in May. It did dip down to about 20%. But has since climbed back up to 26.5. So not strength or weakness really among Republicans. But if you look at the Democrats line here, all the way from we see here Democrats had a net favorability of 32% back in March of 2022 for Tesla, and that has since fallen all the way down to 10%. So you've got about half of the population here on political affiliation that has a much lower favorability rating on shares or on Tesla as a company. The article goes on to argue, and I agree with it here, that recent sell-off in shares of Tesla is likely overdone on the production cut news. That production cut is more likely a result of just ramping up production over the last couple of months than any real weakness in demand or production on that side. But that longer-term production may be at risk as Elon Musk becomes more of a partisan figure and overtly political. Click on the video to the right for the 9 stocks that could save your life. 9 stocks to buy, and I guarantee one of the weirdest investing videos you will ever see on YouTube. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.